The world believed the financial system was stable. Banks, regulators, and investors operated under the assumption that markets were self-correcting. They trusted models, ratings, and historical trends. Few realized that invisible decisions were quietly setting the stage for a disaster. It began with mortgages. Not ordinary mortgages, but complex financial products that were sold to millions of Americans. Banks approved loans that, under traditional standards, should never have been issued. These decisions seemed small, isolated, and manageable. Individually, they were minor. Collectively, they were a ticking time bomb. Lenders relaxed standards to expand business. They believed that rising home prices would cover risk. If borrowers defaulted, the value of the underlying property would increase, protecting the loan. This assumption was not guaranteed. Yet executives, focused on short-term profits, overlooked warning signs. Mortgage-backed securities became the vehicle for profit. Banks pulled mortgages into complex instruments and sold them to investors worldwide. Each security carried the promise of stable returns. The reality was far more fragile. Risk had been underestimated, obscured by complexity, and packaged as safe investment. Credit rating agencies played a role. They assigned high ratings to securities filled with high-risk loans. Investors trusted these ratings. They assumed the products were as safe as government bonds. Few questioned the assumptions underlying these assessments. The invisible decisions of rating agencies magnified the risk. Investment banks packaged risk in increasingly complicated forms. Collateralized debt obligations allowed investors to buy slices of mortgage pools. The idea was diversification. The reality was concentration of risk hidden behind mathematical models. Executives assumed models were accurate. They assumed human behavior would follow predictable patterns. At the same time, regulators turned a blind eye. Policies encouraged home ownership and market growth. Oversight lagged behind financial innovation. Complex instruments were not fully understood. Small decisions, like permitting looser lending or allowing new securitization methods, accumulated into systemic vulnerability. Financial institutions also relied heavily on short-term funding. Banks borrowed billions in the overnight markets to fund long-term investments. The logic seemed sound. The risk seemed manageable. Yet this decision created a fragile structure. If confidence faltered, liquidity could vanish overnight. Consumers contributed unknowingly. Millions took on adjustable-rate mortgages, believing that refinancing or rising home prices would protect them. They assumed stability. They assumed that the institutions providing the loans had factored in risk. These assumptions were invisible but critical. Executives at major banks made decisions to maximize short-term profit. Bonuses, stock options, and market pressure incentivized risk-taking. Every decision to approve a high-risk mortgage, securitize it, and sell it quickly reinforced a system increasingly detached from real-world stability. Derivatives amplified the problem. Credit default swaps allowed institutions to insure against risk. This created a false sense of security. Institutions assumed protection existed. The reality was that exposure was growing in ways few fully understood. Small, invisible choices multiplied systemic risk. Housing prices were central. Rising values reassured lenders, investors, and homeowners. Each price increase reinforced the belief that the system was safe. Yet, this was a fragile foundation. Housing markets do not rise indefinitely. When prices stalled, the invisible decisions of years came crashing into reality. Bank culture contributed to the collapse. Risk managers flagged concerns, but leadership often ignored them. Growth and profitability were prioritized over caution. The human factor, confidence, and institutional culture played a larger role than any spreadsheet or model could capture. Investment banks also engaged in leverage. Borrowing multiple times their capital to invest in complex securities magnified returns but also magnified risk. Executives assumed markets would remain liquid. They assumed valuations would hold. Small decisions about leverage ratios became catastrophic when the market turned. Regulators assumed transparency existed. Public filings, ratings, and financial statements created a veneer of stability. Few looked beyond surface-level data. The invisible complexity of derivatives and off-balance sheet entities hid exposure from view. The system appeared stronger than it was. Credit rating decisions were particularly consequential. A AAA rating on a mortgage-backed security implied safety. Investors relied on these ratings. Few understood that the underlying loans included subprime borrowers and adjustable rates. The invisible trust in ratings magnified the fragility. Globalization of finance worsened the impact. Banks and investors worldwide purchased these securities. Risk was no longer contained domestically. Invisible decisions in one city affected markets thousands of miles away. The interconnection amplified the consequences. Consumer behavior also played a role. Millions defaulted when adjustable rates reset. Foreclosures increased. Housing prices declined. The assumptions underlying every invisible decision about refinancing, market growth, and liquidity collapsed. As defaults rose, mortgage-backed securities lost value. Institutions that had assumed safety faced sudden losses. Confidence evaporated. Banks refused to lend to each other. The invisible structure that had seemed solid revealed itself to be fragile. The domino effect began. Lehman Brothers filed for bankruptcy. Financial institutions worldwide felt the shock. The invisible decisions, relaxed lending, overleverage, reliance on flawed models, and blind trust in ratings, unfolded into a full-scale crisis. The human consequences were staggering. Millions lost homes. Jobs disappeared. Retirement savings shrank. Governments intervened with bailouts to stabilize the system. The crisis revealed that the invisible decisions of a few executives and institutions affected the lives of millions. Central banks acted to restore liquidity. Emergency measures stabilized markets, but the consequences lingered. Confidence in the financial system was shaken. Trust, once assumed, required rebuilding. The crisis demonstrated that small, invisible decisions accumulate. Each choice to prioritize short-term profit, to assume rising housing prices, or to rely on models without human oversight contributed to systemic fragility. Bank culture, regulatory assumptions, investor trust, and consumer behavior intertwined. Each invisible decision, rational in isolation, combined into catastrophic outcomes. The 2008 financial crisis was not the result of a single event. It was the outcome of years of choices, assumptions, and models that individually seemed rational but collectively created disaster. It revealed the complexity and fragility of modern finance. Transparency is limited. Complexity can obscure risk. Human assumptions, incentives, and blind trust can magnify the impact of invisible decisions. Even today, lessons remain critical. Regulators, banks, and investors must recognize that small, unseen choices can accumulate into systemic vulnerability. Awareness of the invisible factors behind decisions is as important as understanding the numbers themselves. The crisis showed that human behavior cannot be fully modeled. Confidence, fear, and psychology interact with markets. Invisible decisions, guided by incentives and assumptions, can ripple outward in ways no model can predict. Financial systems are resilient only when assumptions are continuously questioned, incentives are aligned with long-term stability, and risk is understood at every layer. Ignoring these lessons allows invisible decisions to quietly accumulate once more. The 2008 financial crisis was a warning. It revealed how invisible decisions, taken across institutions, regulators, and households, combine to produce global catastrophe. Understanding these choices is crucial. The story is not just about numbers. It is about the human decisions behind them and the invisible forces shaping the world of finance.